So the number one thing we do for our clients here at 42 Macro, we help them identify a position for the market regime via our global macro risk matrix that determines the market regime. And then we filter those signals to retail investors via KISS, and we filter those signals to institutional investors via Dr. Mo. And then everything else we say is purely designed to help you build the confidence required to dispassionately execute our KISS and Dr. Mo signals when it's time to dispassionately execute them. So, and the best way we figured out how to do that is to help you understand the full distribution of probable economic outcomes at all times so that you're comfortable with whatever the market decides it wants to price in. You know, it's not our job to tell the market to price in Goldilocks or reflation, inflation, or deflation. It's the market's job to determine that. It's our job to notice it and pay attention and do something differently in our portfolio when the market decides it wants to do something differently in terms of what it wants to price in. That's our, if you want to remain on the right side of market risk, you don't have to remain on the right side of market risk. You can remain on the wrong side of market risk indefinitely as a retail investor until your account hits zero. As an institutional investor, as someone on the buy side, you stay on the wrong side of market risk for more than a couple of months, you might be selling insurance. And so this is why we built our process. This is an institutional macro risk management process, and I dare say it's highly effective. We use our global macro risk matrix to nowcast the market regime, which investors must position for to avoid FOMO or FOML. Fear of missing out causes investors to buy cycle tops, and fear of more losses causes investors to sell cycle lows. How many people are out there suffering from intense FOMO right now? Millions, perhaps. You know why they're suffering from intense FOMO? They're getting waterboarded with tariff talk all day, every day, and their general sense of economic anxiety and policy uncertainties at an all-time high, or as high we can see via the Baker Bloom and Davis index is as high as it's been at the height of COVID and the height of the global financial crisis. Now, in my opinion, this is not the height of COVID or the global financial crisis. People were just going nuts. And so, in my opinion, take advantage of the fact that they're going to have to capitulate to the upside in the coming quarters. It may not be next week, next month, or even the next 3 months, but in our view, over the next 12 months, there's a large swath of investor consensus that needs to do something about the FOMO they're feeling. You know what they're going to do? They're going to buy. You want to have already bought before they get their buy. You want to be in line in front of them. You don't want to buy after they buy. You want to buy before they buy. And that's what KISS and Dr. Mo do. It's trying to stay at the van, help trade. It's trying to keep your portfolio at the vanguard of what everyone else knows. I'm not smart enough to know everything. Newsflash. I'm pretty smart, but I'm not smart enough to know everything. You know who knows more than me? The S&P, the emerging MSCI Emerging Market Index, the Nikkei 225, the NASDAQ, the Russell 2000, Shanghai Composite, and the Euro stocks. Implied volatility correlations, currency volatility, bond market volatility, equity volatility, crude oil, ag commodities, industrial commodities, silver, Bitcoin, Aussie dollar, US dollar, euro, British pound, Swiss franc, Chinese yuan, Japanese yen, gold, 10-year German break-evens, 10-year German nominals, 10-year Japanese nominals, 10 rates, 10-year UK nominal rates, the high-yield credit spreads, high-yield yields, investment-grade credit spreads, investment-grade yields, 1-year US dollar OIS, 1-year US euro OIS, 1-year British pound OIS, 10-year British pound break-evens, 10-year treasuries, 2-year treasuries, 30-year treasuries, 10-year US break-evens, 10-year real tips yield, and the 2-10s curve. These markets know way more than I do because there's other investors participating in those markets determining the BAM signal. And that's why we use this to determine what the market regime is. I don't just wake up and go, well, I did some research that was bullish, so therefore I think the market regime should be bullish, or I did some research that was bearish, therefore the market should be bearish. That's not how the world works. You have to separate what you think and just accept that the market is smarter than you and is going to do whatever the heck the market wants to do. So it's our job to ride the bull or get out of the way of the bear. It's not our job to tell the bull to bull or tell the bear to bear. It's our job to ride the bull or get out of the way of the bear. If you start investing with that level of humility, your results will be way better. And the reason we are systematic investors is because it forces that level of humility upon me and the things that I communicate to you. And so what I'm communicating to you today is that we remain in a Goldilocks market regime. 22 of these markets, I'm knocking on the door of 42 of the world's most important markets and saying, hey, what do you think about the market? What do you think market regime we're in? Hey, what do you, S&P, what do you think? 10-year treasury yield, what do you think? Currency volatility, what do you think? Implied volatility correlations, what do you think? And each one of these, every single day, Every single day, they have an answer. And if we tally up their answer based on how they've historically traded across the four different market regimes, Goldilocks is risk on with the disinflationary bias, reflation is risk on with an inflationary bias, inflation is risk off with an inflationary bias, and deflation is risk off with the disinflationary bias. Based on how they've historically traded, each of these individual features in this model will tell me, hey, there's more of us that think it's a Goldilocks than there is reflation, inflation, and deflation. Therefore, we as investors are going to orient our portfolios with the people with the regime that has the most love. Kiss and Dr. Mo are going to reflect being in Goldilocks. And when that changes, it'll change. And we just have to dispassionately execute that signal. I don't know how long we'll be in Goldilocks. I can paint a very credible picture that we can remain in Goldilocks between now and let's call it next summer, based on our paradigm C basis. But there's also some things that I think the market might get concerned about along the way, which may create, a transitory risk-off inflation market regime or transitory risk-off deflation market regime. I don't know. It's not my job to tell you, oh, that's going to happen on August 2nd. It's my job to wake up and do my job on August 2nd. And if it happens on August 2nd, signal it to you so that you guys can make the appropriate pivots in your portfolio to manage risk in order to remain on the right side of market risk so that you can compound returns from a higher net asset value than the other people who are suffering the drawdown and suffering through the volatility drag. If you compound, if you stop, if you comp, your account should look like this. Other people's accounts look like this. This is stressful as hell. You should be trying to avoid that. Period.